Good morning, everyone, and thank you for joining us for today's free webinar, Startup Equity, What Founders Need to Know, with Peter Stone from Hopkins and Carley and Glenn McCrae from Early Growth Financial Services. My name's Erica Malsberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'll be your moderator today. This presentation will run about 40 minutes. If you have questions as we go along, please feel free to enter them in the question field, or you can tweet them to us at EarlyGrowthFS with the hashtag StartupEquity. We'll answer questions as they come if we can, or we'll wait until the Q&A at the end to address them. If we do wind up running out of time, we'll be sure to follow up via Twitter and email after the presentation to make sure all of your questions have been answered. I want to start today by introducing our presenters. First, we're very pleased to have with us today Peter Stone. Peter is of counsel in Hopkins and Carley's Palo Alto office. He's a member of the Corporate Business Transactions and Tax Group, representing startup and emerging growth companies and the individuals who are the executives, directors, and shareholders of these companies. Peter functions as outside general counsel and assists with corporate formation, financing, and contracts that range from simple purchase and sale to complex strategic alliances. Welcome, Peter.
Thank you.
And we also have with us today Glenn McCrae from Early Growth Financial Services. In addition to being Chief Strategy Officer for Early Growth Financial Services, Glenn is an experienced CPA with extensive early-stage company experience. Glenn's experience with smaller growth companies has helped him develop a deep understanding of how sales, strategy, financing, operations, and accounting each play a critical role in the successful growth of a young firm. Welcome to you, Glenn.
Thank you, Erica.
Sure. So, Peter, can you kick us off by telling our listeners just a little bit about Hopkins and Carley?
Sure. Hopkins and Carley is a Silicon Valley law firm with offices in Palo Alto and San Jose. We have about 70 professionals. Our clients are mostly private held companies from startups through 100 million and above in revenues in a variety of industries, both tech and non-tech. And our services cover a broad range: corporate, which I'm in, IP, employment, real estate, litigation, and estate planning.
Great. Thank you so much. And Glenn, can you just say a few words about Early Growth Financial Services?
Yeah, I'd love to. Early Growth is based in the San Francisco Bay Area. We do have a national presence with offices and representatives in Los Angeles, New York, Chicago, Boulder, Colorado, and Austin, Texas as well. We also Seattle, don't want to forget about Seattle. We have about 18 CFOs and 55 senior accountants. And our primary role is to help early stage companies with pretty much anything other than sales and operations. So think back office. Finance is our key function, and we would help you with a monthly close and generate financial statements. Our firm also provides tax and valuation services, specifically 409A valuations.
Wonderful, thanks. So we have a lot to cover today, so let's just go ahead and dig right in.
So this is Glenn speaking, and I just wanted to let you know, as an overview, what we're here to talk about is just the whole concept of raising capital and what that means for the equity structure of your company. One of my roles in working with the 400 plus clients that we have is to make venture capital introductions to the clients that it's a fit for. And not everybody needs to be venture backed. We have plenty of clients that have been bootstrapped and were able to get to a profitable scenario without raising outside capital. But in general, most of our clients are venture backed. And I think it's pretty obvious to everyone on this call that one of the big motivators for you to form your company and to have that huge success is that it's a shared success. That shared success comes in the form of the equity value of your company increasing dramatically. You're coming from a very low base, you have very little resources, but you're going to achieve something great. And that's what we talk about when we say equity plays. And what we're here to talk to you about is just opening your eyes and thinking about who are all the stakeholders that are going to participate along with you as the founder in this equity play. And how should you approach your relationship with these folks?
And I just wanted to throw in a footnote to this, that one of the issues that comes up early on is what form of entity should I start? And just to be clear, because it's an equity play, the legal structure is going to be one that facilitates people reaping the rewards of participating in a startup through the sale of their stock. And so that typically means it's going to be a C Corp, not an LLC, not an S Corp. And these days it's usually Delaware Corp. So let me just define the first real round as it says on this slide. Usually people are referring to a Series A preferred round that's going to involve the first venture capital or other institutional money coming in, and it'll be the first priced round. So one of the key messages for this session is that you need to start developing your capital strategy right at the outset as part of your first business plan. Your first investors, at least the more sophisticated, will be asking these questions of you. How much capital are you going to need overall? What do you need it for? Where are you going to get it? How are you going to stage it? And what milestones are you going to try to hit with each increment of capital? It's good to anticipate these questions from investors because they're the very questions that you need to be asking yourself as you start to raise money. And you need to know that as you look ahead that every decision you make about equity is going to be noticed and have an impact when you sit down to negotiate the terms of your Series A.
I'm going to...
Great points, Peter. I think the thing that we want to focus on here is the concept of a priced round as well as milestones. We realize that some folks, that these are going to be new terms for you. For others, you're going to know exactly what we're talking about. So Peter will talk a little bit further about priced rounds and what that means, but what's the concept of a milestone? So everybody here on this call is going to have a different way of approaching their business. At the earliest stages, there are all sorts of unknowns. You may have some real insights into a particular vertical market, but you're trying to figure some things out. Some of them may be technology-based, some of them may be customer-based, some of them may be strategic relationship-based. So the concept of a milestone is one where you've achieved some significant success. And it could take the form of a number of different areas that we just mentioned. But when you achieve that success, it's going to lessen the risk that your business may not be successful. So you can think about that in terms of you've got your first beta client. You've got your first working prototype of your technology. You've got your website up and running, and you've been able to charge credit card transactions to customers. Those might be the earliest stages. Then the next round down might be, well, we've been working on getting a strategic relationship in place. We now have that strong strategic relationship that's going to fuel our growth. So very often, each stage, as Peter mentioned, each stage of investing is going to be geared towards a significant milestone, raising a certain chunk of money to get to that next stage. And once you reach that next stage, that's going to result in a higher valuation of your company because you've lessened the risk that you won't be successful and you've created a path towards greater success.
Great. Before we move ahead to the next slide, I have a question on the previous slide in regards to business entity. Neil wanted to know, can an LLC be converted to a C Corp?
The answer is yes, and it is actually not that difficult to convert either an LLC or an S Corp to a C Corp, and there are oftentimes reasons to start off in one of those, we'll call the flow-through from a tax point of view entities, but then you'll convert to a C Corp before you get too far down the line in raising capital. And while it's fairly easy to go from LLC or S into C, it's more difficult to go the other way, but typically people don't need to.
Okay, great, thank you.
And on that question, Erica,
yep.
is when you do convert from an LLC to a C Corp, just be in mind that you have to file a final tax return for that LLC. So that's just something that sometimes people forget about, and you should also be very careful about having your cutoff from an LLC to the C Corp, and you need to set up new banking relationships under that C Corp. So accounting issues come into play if you're going to take that approach.
Okay, and this spurred a lot of questions, so let me take the time to ask them while we're here. Brian wants to know, how important is it that the C Corp be registered in Delaware?
Well, it's become kind of the norm in Silicon Valley for startups where people are expecting to grow towards either significant acquisition exit or an IPO to start off in Delaware. The reason that the sophisticated investors prefer Delaware is that Delaware has by far the most developed body of corporate law, which means that you know the answers in advance to many more questions that might be asked about the corporation from a legal point of view than you would know in any other state, including California, just because the courts have ruled on a lot of the issues that get presented. It's also, Delaware corporate law is among the most flexible in terms of the way you structure your corporation. So those are the reasons people prefer it. On the other hand, there are many here in California that are incorporated as California corporations. Some of those, certainly those that are getting ready to go IPO, typically will reincorporate at that point in Delaware. That's a somewhat expensive process, so one of the reasons people are starting off in Delaware so they don't have to do that later on down the line. But you certainly can, certainly viable as a California corporation. It's not a huge barrier to investment. It's just typically your institutional investors, particularly the VCs, would rather see you as a Delaware corporation.
And just to echo what Peter is saying, you will often see the case where professional advisors such as lawyers or CPAs are going to suggest that you do things right because to do it, fix it, and get it set up straight after the fact is usually more time-consuming and more expensive.
Great. We have a few more. We have a few more questions here. Is it okay if we linger here for a little bit, guys?
Sure.
Sure. Okay.
Where there's a lot of interest.
Okay. Sure. So we have Greg here wants to know, can convertible notes be utilized as a raise for an LLC or S Corp as well?
They can, but it's I guess it's more complex. I actually haven't seen it done much. Usually, people are taking a membership interest in an LLC, but certainly you can pay for that with a convertible note. It's just not done a whole lot.
Yeah, there's all sorts of issues from a tax perspective, and that will create an expensive tax return if you take that approach. Anything's doable. And we could talk for a bit of time on that issue. It's not the recommended approach.
Okay. In terms of the conversion that we were talking about before, too, Neela would like to know, is the conversion an expensive proposition? Like, what are the approximate costs? Especially for one example, if you filed for 1 year of tax return, no revenue so far, just expenses. I mean, that's a pretty specific question, but you have a general answer for that.
Well, the legal end is pretty inexpensive. It's probably going to be a couple of $1,000s. I'm not sure about the tax end. I'll let Glenn answer that.
Yeah, an LLC tax return is more expensive than a regular C Corp return because there are K-1s that have to be filed, so you can't really answer off the top of your head exactly what the cost would be, but a simple tax return would probably cost about $2,000. And if you had a C Corp structure, you wouldn't need for the LLC. Also, you're going to have some setup issues dealing with a new corporate structure. So you're basically doing the same thing twice. You had to set it up as an LLC. Now you're going to have to set it up again as a C Corp. And then there's just going to be a bit more cumbersome work for your accountants to get things set up straight the first time. It's all doable. It's just a little bit more expensive.
Okay, great. We have some more questions, but just so in the interest of getting through the whole presentation, I'm going to hold questions for right now and get through a couple more slides. So if you want to jump back with the sidebar anatomy of a capital structure.
Sure. I just wanted to make sure that some of these terms that come up a lot, they can be confusing if they've never been defined for people. So I wanted to just quickly run through this. So the authorized shares means the maximum number you can issue before you reauthorize by amending your certificate of incorporation. That's also not a huge deal to do, and certainly companies typically do it at various stages, but at any given point you have an authorized share number, and then everything is issued underneath that. Issued and outstanding is the shares that you've actually issued, regardless of what class you have, and that makes a difference. One of the main areas that makes a difference is those are the only shares that can vote. When you get to fully diluted, it's important from an economic point of view to kind of define the pieces of the pie, because shares that have been reserved or committed certainly would be counted in terms of as the issued shares are looking at their potential dilution, and that's typically the number that is used when you're negotiating valuations. So it's basically the issued and outstanding plus those that are reserved and committed, including the employee pool is usually considered part of a fully diluted number. What we see is stock itself is divided into common stock and preferred stock, and the preferred stock is typically going to be convertible into common, and it's usually sold in series at different stages and different valuations. So you'll have Series A preferred, Series B preferred, etc. And the common stock has all the residual rights that sort of aren't specifically reserved to the preferred stock. The preferred's given various rights, the most important of which is usually a liquidation preference, which is a right to receive a defined amount in a liquidity event prior to the common receiving anything. And there's lots of variations on that, which we're not going to dive too deeply into here. We'd need an extra hour probably for that, but that's the overview.
Yeah, and just to add my 2 cents here, in terms of who goes into each of these areas, the bottom 3 areas are the ones where the stakeholders reside. So preferred stock is typically your investors, your venture capital investors, angel investors, and as Peter mentioned, there's at least one important preference, which is liquidity, but there are others around voting rights and participation rights and future sorts of things. When you get a term sheet from a venture capitalist, you'll get a real education about preference items. Common stock is usually founders and the earliest people that come into the fund, come into the company. So those are the folks where they have, they're founders, they have a very low basis in the stock, maybe 0, and they're issued shares. They may be restricted so that you may vest in those shares over time, but if you have been issued stock, they will be in the form of common stock. And then the option holders are in that fully diluted area. So option holders don't actually have common stock. They have the right to exercise those options and to purchase for the exercise price those common shares.
And a question from Paul here. He wants to know if you can clarify the difference between issued and outstanding a little further.
Actually, there's really, it's used as a phrase that describes the same thing. So it's kind of, they're kind of redundant. There's not a difference between the issued stock and the outstanding. It's just kind of issued and therefore outstanding.
Okay, great.
Oh, I guess let me clarify one thing. It's issued, it could be, stock can be repurchased, so it was issued at one time, but it's no longer outstanding once it's repurchased. But typically when people are saying issued and outstanding, they're really talking about what's out there currently. Okay, so
when we're talking about founders, go ahead, Peter.
Yeah, so the founder stock, by definition, I guess, is the first stock issued. So on day one, it's 100% of the equity, and from that point forth, it's going to get diluted by each new sale or commitment of equity, and it's unavoidable. That dilution is unavoidable unless you're in a bootstrapped cash flow business where the founders are able to keep 100% if they so choose, but that's really not the focus for this webinar. one of the key takeaways from this is that points are precious. That is, percentages, fractional interest, I'll refer to here as points. And I want to say, don't be lavish with your early stock commitments. It's okay to be stingy with equity. In fact, I think it's a good idea. On the other hand, don't be miserly. You'll just alienate the people that you need to be successful. And always remember that 20% ownership of $1 billion company is $200 million, but 100% of zero is zero. So now let me move on to the second bullet, co-founders, because this is a very key subject, and a lot has been written and spoken about it. My 2 cents, the majority of successful startups have more than one founder. In the prototypical tech startup, you're going to be having at least a business founder and a technical founder. And if you have those two from the beginning, they are really like partners, and the equity shares will typically approach 50-50 in a 2-person founder group, more pro rata if it's larger than 2. If someone is clearly the lead and the CEO, then he or she is probably going to get more than the other founders. But then often you have a first founder who's out there evangelizing and getting things rolling for a period of months, a year, 18 months even. And then you have other co-founders based on, sort of the way they join, the roles that they join for. But the split is going to be different there. The original founder is going to probably have at least 2-to-1 what the others have, or maybe as much as 5-to-1. It's a negotiation, and it depends on the market, the unique skill sets and the combinations. So it's hard to be more specific than that. You have issues, more technical issues, and I think given the way the time is running, I'm not going to delve into them around the initial capital contributions. We can obviously take some on Q&A. I think Glenn made the point that the founder stock is issued at typically a very low price, and you have to sort of mesh that with the capital contributions and the actual stock issuances. It's part of the reason you can do that is it's generally understood that the pricing of the founder stock is not a benchmark of valuation for later stages. It's basically intended to be almost free or almost free because it's all about the sweat equity that the founders are putting in. A key issue is whether the founder stock is going to be subject to vesting from the beginning or not. And vesting, if you haven't run across that concept, is basically that you have to earn your right to keep your stock by your continued service over some period of time. Typically for employees, it's 4 years. And some founders will say, I'm the founder, it's my company. Why would I voluntarily put myself in a position to lose my stock if investors come in later and then decide that they want to have someone else running the company? And it's an understandable point of view, but if you take that position initially, you need to be prepared that the investors are probably going to require you to vest some portion of your stock as golden handcuffs to make sure that you stick around. My point of view, if you have a team of founders and key early stage executives, each of whom has an equity position, you don't want anyone to depart the team and keep all of their stock. So you're going to have to use some of that stock that they may have to give up if they have invested in it to hire a replacement. So my advice is to basically always have vesting. Maybe you pre-vest for the early founders for credit for the time that they put in before the company was organized. But again, you want to keep the whole team together, and if anybody leaves, you need to get some of their stock back.
Okay. About is the seed stage, and for those who might not be familiar with the basic vernacular around raising capital, if you haven't raised any outside money at all, you're referred to as being bootstrapped. Typically when you go to your first outside money, it's considered seed stage, but some entrepreneurs like to refer to that as pre-seed. So if you're just going out to friends and family, and you're raising a fairly modest sum of money, let's say a couple $100,000 or less, you may not refer to that as your seed stage. You may, when you get to that 500,000 to $1 million to 1.5 million, when you're getting real outside investors, people that are professional investors or sophisticated angels, you might be talking about that as your seed stage. And then once you get past the seed stage, it's A, B, C, and so forth. So what we're here to talk to you about is kind of the concept of what does it mean to get into that seed stage and what should you expect?
So we've broken this down into the two bullets there, friends and family, and then the more sophisticated angel investors. Friends and family, it's a little, well, it can literally be friends and family. It can also just be people that you meet as you're getting started, and they maybe have had their own companies before, and they're possibly involved in this industry that you're working in, and something that gives them an interest, affinity for what you're doing, and they'd like to help you out and hopefully make some money in the long run. So those folks will be putting in, the typical range is $25,000 to $50,000 each, but some it goes up to 100 or even more in some cases. When you get to the later stage angels, these may be professional investors investing in early stage deals where they are hoping that the outcome of those investments is going to be a lot of the accretion of wealth that they're going to see. Some are former VCs who are now investing for their own account as opposed to managing pools of funds that were raised from limited partners. Others are successful serial entrepreneurs who are now investing money and usually time also as mentors to the companies that they and the CEOs of the companies they invest in. I'm going to say that the seed stage typically covers the range of about $250,000 to $750,000. I'll let Glenn comment on that because he was using some larger numbers. But in some cases, it could be less. If the market for your deal heats up, you might find some VCs wanting to jump in with an early Series A. Once you go beyond, in my experience, 750 or so, you start to raise some concerns by later investors that you may have taken too much capital at that point, which is a form of dilution in advance for them, as opposed to the post-investment dilution that everyone will suffer. Glenn, did you want to comment on the size of the seed?
Yeah, one of my roles at my company is to introduce our clients and our prospects to venture capitalists where there's a fit. So I'm spending a lot of time getting to meet the venture capital community. We've got a database of about 200 VCs that we interact with. And I'll just tell you, they all have a different way of looking at things. We're going to talk about convertible notes here in a bit. And I'll tell you that there are some VCs that won't do convertible notes. So when you talk about seed, you talk about A, I just know from experience that they have different approaches to how they define those stages and what dollar levels they commit in. Whether you call it an A stage or a seed stage, sometimes that's just a difference in terminology.
Yeah, and it's a good point. We're giving you sort of the paradigms and the vocabulary, but people really, there's a wide range of variation, and there's a lot of customization that goes into each deal, partly based on the nature of the deal, partly the outlook and the philosophy of the investors. Let's get into the convertible note structure, which is the most typical structure used these days, at least in the seed round. It's a loan, but I'll put that in quotes because it's intended by both parties not to get paid back as a loan typically would be, but to convert into equity when the Series A financing occurs. Sometimes I see entrepreneurs accepting the early investments without much of a legal structure, just cashing the check. But I will say, echoing what Glenn said earlier, this informal approach can cause problems that are more expensive to fix later than it would have been to avoid them in the first place. And sometimes some of those problems can actually kill the next deal, so you really want to be careful. The key terms in the convertible note, the discount percentage. And notes usually convert to Series A at a discount to the price that's being paid by the Series A investors. And that's the compensation to these early investors for the risk that they took by coming in early when there's just more risk in the company. And this discount is usually in the 20 to 30% range. I've seen lower and I've seen higher. It's negotiable, but that's the tip. Then there's another key term. I don't see it in every deal, but I see it in a lot of deals, which is a cap. And that would be the number that is the maximum conversion valuation for the seed investors. So if the value kind of runs up going into Series A, you know, maybe you have a competitive situation where you have more than one group or investor that's trying to get the opportunity to invest. The discount that is in the convertible note may not be meaningful compensation for the degree of risk that the early investors took. So, you know, the whole reason for the note structure is to postpone the series valuation discussions until the company's further along. And then but tying the equity participation of the seed investors into the valuation that gets negotiated later on a larger deal by the knowledgeable investors and the business being further along. And that's what when we talked about priced investment, that's really what we mean. It means that we're now going to really fix a valuation per share price. So the cap, again, gives the early investors some absolute protection, assuming that it is respected. I have to say, sometimes the Series A round will involve some negotiations between the investors coming in at Series A and the seed investors if the new investors feel like the deal was too rich for the seed investors, and they're going to make it a condition of their investment that there's some renegotiation. That's a pretty messy situation because you've got to go back and get the seed investors to you know, sort of agree to it, to swallow hard and agree, and that can be challenging. Other issues that you'll see in the convertible note is what's the definition of a qualifying transaction that's large enough or significant enough to trigger the conversion, and what happens if you get to the maturity of the note, which is usually going to be somewhere between 1 year and 2 years, and you haven't had a qualifying transaction. There's a bunch of ways to address that. So this is not an exhaustive list of issues, obviously, but I think you'll see that you want to be working with somebody who understands the structures and when you're putting this together. And just remember that the Series A investors will take a critical look at what you did in the seed stage.
So we have quite a number of questions here on this slide. So before we move on, I'm just going to toss a few out there. Okay. First, Melissa wants to know, do friends and family need to be qualified investors?
You should always try to ensure that all of your investors are, at the early stage, are accredited. And let me just back up a second to make the point that whenever you sell equity participation in any form, that is a securities transaction. That is a regulated transaction at both the federal and the state level. And the default rule is when you issue securities, you have to register them. But, of course, there are a bunch of exemptions, and actually that's what we rely on. We try to do only exempt transactions. But condition of sort of a clean exemption at the federal level is that your investors are accredited. And that is a test that's based on, there's 2 prongs. You have to satisfy one or the other. The investor either has to have $200,000 of annual income in the last 2 years and a reasonable prospect of the same level in the current year, or $300,000 together with their spouse, or they have to have $1 million of net worth, not counting their equity in their home.
And it's 1.5 million now.
Oh, it's up to 1.5. Sorry. Yes, that was the.
And you know, that's good guidance, anyways, because you know this should be money that people can lose and not miss it. So they should be accredited.
If you can use those federal exemptions that rely on the accredited investor, then you can avoid a lot of more difficult issues at the state level, where a lot of states, if you have that type of an exemption at the federal level, they'll just say, well, then you're exempt with us too. If you're relying on a more difficult exemption, there's one you'll hear referred to as 4.2, which is a reference to a section of the Securities Act where basically it turns on the sophistication and investment experience of the investors in early stage investments, and that's a little bit more difficult to establish. So if you take money from people that don't meet these standards, it's just adding a degree of risk to the deal, because in the end, kind of your worst case scenario is that you have to actually make what's called a rescission offer, which is you have to go to everybody who was part of that round and say, if you want to rescind your purchase of equity, we will refund your money. And you have to register that with the state of California. So that is a situation that you want to try to avoid. So I always ask my founders to use investor questionnaires and basically say we're limiting this deal to accredited investors. That said, particularly with the earliest money, family, and so forth, it's a pretty thin case that's there for the exemption.
Okay, and just a couple more before we move on quick. With the understanding that it's highly variable, can you give our listeners a sense of what's the going rate of the seed versus Series A investment in terms of percentage?
Well, the Series A percentage is going to be based on different things than the seed. So the key term there is really the two terms that I talked about, which are the discount and the cap. When it gets to the Series A, you know, I suppose a normative number to start off with is 50%. That is that the Series A investors may want to take 50%, but it depends on the size of the deal. It depends on whether you have a hot deal or a deal that's struggling to get done. You know, you can go anywhere from, I would say the relevant range might be 30 to, you know, 2/3 might go to the investors if you're raising a lot of money and, you know, there's still a lot of risk in the deal.
And great. One more question before we move on. Can you just discuss convertible equity versus convertible debt? Brian wants to know.
Well, the issue is with convertible equity, it will have to be a priced round. So you will have to negotiate a valuation that may or may not be, you know, look appropriate when you get to the Series A round, and if it's pretty painful to go backwards in price. So that's one of the reasons why people don't. I mean, if convertible equity is going to be probably you know, a Series A, I suppose you can have a common where the common can convert into Series A just like a convertible note would. I haven't seen that done much.
Yeah, I think you're either in a convertible note situation or you're in a priced round. I'm not familiar with the concept of convertible equity.
Okay, great, thanks.
Okay. So every startup needs advisors. Obviously, they provide mentoring and advice, particularly in areas that aren't the strength of the founders. A good example, marketing strategy, where no one on the founder in that area. There's also a sanity check on the strategy and tactics that you're following. Typically, they have a lot more experience in startups than many founders, first-time founders. They also make key introductions a lot of times with potential team members, funding sources, or other experts. And often, I almost could say usually, they'll be making a modest investment themselves in the seed round. Not all of your advisors need to be board advisors, and not all startups have anything they call a board of advisors. One difference is that board-level advisors are, I will say, typically important enough to be given equity. And a typical number there is going to be 0.5%, 0.5%, and it's typically going to be subject to a vesting schedule. Also, I would say that board of advisors is a little bit of a misnomer because they rarely, very rarely meet as a board. Usually, each one is rendering their contributions to the CEO separately, so it's really more like a panel of advisors than a board. A board of directors, a true board of directors, which you probably wouldn't get until you get your Series A round and those institutional investors come onto your board. But it's a different animal. I mean, it provides some of the same value, the mentoring, the expertise, the introductions, but it's also there responsibility to provide oversight of management and the CEO in particular. So the CEO answers to the board, and if the board feels that the CEO needs to be replaced, it's their duty to carry out that decision and hire the new CEO. So they obviously will, unlike a board of advisors, there'll be a regular meeting schedule. Go ahead.
Well, I was just going to echo what Peter is saying. All of those are great points. The other thing to keep in mind, the contacts, and these folks have a certain amount of visibility in the industry. Having the right advisors on your team can really add to the credibility of your organization. So sometimes it's external facing value that you're getting, not just internal.
Absolutely. That's a real important point. I have an important takeaway for you on this particular concept, because this is the first time we've really talked about the percentages of equity that you're going to be committing to people before you do your Series A round. The percentage of equity concept it's got to be nailed down tight. Percent of what? What's the denominator? When is it measured? What's the mechanism for converting the percent into actual shares? Usually the denominator is going to be based on a fully diluted number, although it can be based on the issued and outstanding. It may be a percentage as of the date of the agreement with the advisor or other person, but very often, probably more often, it's a percentage as of the closing of the Series A, which is when the capital structure settles down and you have your valuation, your initial valuation. But what it can't be is left to sort of float on top of the capital structure where it's always the same percentage and it's fully protected against dilution. That's a recipe for disaster. The percentage needs to be converted to an absolute number of shares and then become subject to dilution along with everyone else.
Okay, someone wanted to know, can you remind us quickly of the percent stock you should offer for their services? Did you say 0.5?
For someone who's at the level of a board of advisor who's going to have probably that public face, has a lot of equity in their personal brand, 0.5% is a typical number.
Great, and a couple of people wanted...
And that usually is 0.5%.
Go ahead.
Usually 0.5% at Series A.
Okay, great. And then a couple of people wanted to know what's the best way to recruit these advisors and board members if you don't have a relationship existing prior?
It's all networking. I mean, frankly, almost all of this is, you can't advertise, you can't, you may meet people at an event. I mean, that's the other thing, I guess. It's a form of networking. I mean, you go to an event that's, where it turns out that you and somebody have a common interest and you get talking and, they like what you do, and that can develop into an advisor. Often it'll be somebody that that's been in a similar company, another entrepreneur, and they've met people and they'll make a referral, that kind of thing.
Okay, great.
There can be good reasons to give service providers equity. So get something important accomplished without depleting your very scarce cash. An example from my experience, I was in a part of the management team of a startup for a number of years, and we got a number of patents filed that we paid for completely with equity, and some of those patents ended up being strategic to our business, so that was a good use of some equity. Sometimes you get someone to put their skin in the game with giving them an upside. There might be an expert consultant that you've identified who's basically so good that they're booked all the time and can name their own price from a bigger company. And it's like, how do you get their bandwidth when you're a little startup and you can't put up cash anything like what they're used to getting? Equity participation can be a way. A lot of people like startups. A lot of people like the idea of startup equity. So you also may get a service provider, let's say a PR firm as an example, put in a lot of work on a deferred billing or discounted billing basis if you are willing to provide some equity. And then there are those service providers, and here I would say classic example would be an investment banker or a broker or finder that they base their business model on a combination of cash and equity. And you have to be willing to part with some equity at this early stage if you're going to use somebody like that. It's not actually that common, certainly not investment bankers at the seed stage. Sometimes people do make use of brokers, and that's certainly they're going to want equity. But don't overdo it. I mean, your points are precious, so you can get valuable leverage for the equity, but you have to get value for the value that you give.
So Melissa here wants to know, is it common for a legal professional to get equity for their services? And if so, what's the percentage range?
It's, I'll say, not uncommon. Some lawyers and firms do it more than others. Some make it a regular practice. Others do it on a occasion basis. I would put our firm in the latter category. We don't do it in every deal. The percentage is likely to be similar to what other service providers, including advisors, get. So it's going to be certainly sub 1%. If anybody wants more than 1%, there better be an awfully good reason. 0.5% wouldn't be an uncommon number.
Okay, great. Oops, sorry about that.
So what we're talking about here is, think about, if we go back to the beginning slide, who are the stakeholders? Who's going to be in the game with you? Who do you want to have their interests aligned with your interests? And clearly, employees fit that characteristic. The employees that are attracted to startup companies, first of all, a lot of them are engineers. A lot of them come from the ecosystem. They understand what the game is. And that's what we're kind of talking about here, is the folks who are going to come on board, not require the fair market value for their services in the form of dollars, cash up front or cash in salary, but have some of their upside defined as participation in stock options.
So one of the key features of your capital structure is going to be this line item for the employee pool. And that's an allocation of shares out of the authorized but unissued capital stock that you're going to use to provide these equity incentives for employees, but it can also include directors, consultants, advisors can be part of this pool. And again, the typical percentage that goes into the pool can vary a lot. It's also negotiable typically with your investors, but a typical number is going to be 20% of the fully diluted will be in the equity pool. And as we mentioned, the options, because mostly with employees you won't be issuing the stock outright, you'll be granting options. They'll be subject to vesting, 4 years being the normative kind of schedule, and if people leave after 2, then half of the shares where they were initially granted will come back into the pool. And if they don't exercise the vested shares, and oftentimes certainly in the earlier stages before it's clear that there's going to be a liquidity event, a lot of times people don't exercise the vested shares, so those would go back into your pool as well. And there are a lot of considerations about the philosophy of using the pool. Does it get added to and people get green up options, as they're called, after they're half vested or whatever? You start to worry about, are the golden handcuffs still tight? How do you distribute the shares? Some companies, some managements or boards really like an equity approach that's very heavily slanted towards the more senior positions and maybe doesn't even provide equity to the lower level positions. Others want to spread it around more widely and have everyone in the company have equity. So those are really almost philosophical issues. I don't think anybody could make a scientific case that one is better than the other in terms of your long-term valuation. But people have strong opinions about that, as well as everything else relating to startups. And so you just have to find your way and what's comfortable for you. But it is an important issue, and it is something that gets negotiated with investors. Sometimes they'll have the view that you don't have enough shares in there to do a good job of recruiting and incentivizing people. Other times they may feel like shares for the employees compared to what the investors are going to get. I'm not going to try to cover the differences between options and restricted stock. If people want to raise a question about that in the Q&A, we can talk about it a little bit.
Along the lines of what you've been talking about, someone's asking for a little more elaboration, like how much should it be padded to account for dilution?
Well, I don't know if that's a question in terms of the pool, the dilution of the pool. I'm afraid I'm not sure what the question is.
Yeah, I'm assuming pool as well. It's not clarified. Yes, sorry, yes, option pool, yes.
If you go back to Peter's earlier comments, if you're looking at the fully diluted set of stock equivalents, 20% might be allocated to that employee option pool. And what you're thinking about in terms of when you allocate those options, so that's already included in the fully diluted. That's the maximum amount of stock options that are going to be granted. And so as a founder and a CEO and a board member, what you're going to be looking at is how do I allocate that 20% to my employees over time? And as Peter was talking about, you might do, for somebody who's on board day one, they may get a certain package, but if they stick around for another 5, 6 years, they may get another grant after they've fully vested in that first grant that they've received. So there's a whole strategy around how you allocate options to your employees.
Yeah, and I guess this could have been part of the question. It's important, it's obvious that you're going to deplete this pool as you grant options and they vest and some people exercise. So there's always a discussion ongoing about when do we increase the pool and by how much, because you have to, over the several year life of a company, pre-IPO, shall we say, or pre-liquidity, the initial 20% is not going to be enough. And that can be a very hard issue sometimes. There can be real differences between the management. And typically then later on, the management wants to push for a larger increments to the pool, and the investors are kind of resisting the dilution. The management is trying to company or bring people into the company and more to work with there, and the board investors are saying we think that the employees have enough or grow it that much. Dynamic a lot of time.
And I think you kind of addressed this already, but can you just clarify how the stock pool and equity pie differ structurally?
Well, if you look at the whole equity pie, I think the first slide has a picture of a pie with slices in it. The pool is one slice. It's kind of a dynamic slice because it changes over time. But as Glenn said, that pool is part of the fully diluted number. And all of your valuation negotiations and your valuation, when you have formal valuations done by valuation experts, they all treat those shares as if they were issued when they're valuing the enterprise.
Great, thanks.
So we've talked about this all through, the relationship between the seed and the Series A. There's going to be a marked shift in the relationship of the founding team and the founding CEO to the investors when you transition to the venture stage, the institutional stage. The seed stage, many times your interpersonal relationships with those investors are sort of paramount. Later on, they're important, but they're not as important as the company and the individual performance. In the early stage, the ability and transparency with what's happening and is really determined by the CEO. After you take your institutional money, the transparency is going to be mandated. You're going to need to report. You're going to be required to report, at least to the board. Whether you report much to the broader shareholder base is, a question that you'll have to have dialogue with the board about. In the early stage, the investment is usually viewed as kind of a one-off, a one-time yes/no decision by the investor. But later on, the investors who come in are going to be thinking in terms of the likelihood that they'll need to make a follow-on investment, and they'll be probably having certainly venture capitalists do this routinely. When they decide that they're going to invest in a company, they only invest a portion of what they're ultimately willing to invest in the Series A round, and they're going to hold some back to participate in later rounds and to support the company, but also to avoid the the dilution that they would get if they don't participate. Glenn, any comments in that area?
Oh, you've done a great job of explaining it all very well, Peter.
So I guess as a summation, I'll just repeat, equity is really the lifeblood of the startup, and your capital strategy is as important as any other element of your strategy as a company, and it's best to treat it that way from the beginning.
So we have
echo Peter's comments. I will tell you. Why don't you turn it over to questions?
That's okay. Why don't you have your summation, and then we'll get through as many questions as we can, and we'll follow up after if need be.
Yeah,
okay.
I think I've stressed the points all along, the ones that were at the beginning about the strategy and understanding what your capital needs are and how you're going to try to de-risk the company as you go along and stage the investment so that your value can be going up and your dilution, even though you're taking more money, your dilution is less. And never forget that points are precious.
Yeah, my final points are just always have the end in mind, just like any other good plan. Think about what the end game is. Try to make wise decisions in terms of bringing people in, because you're all in this same game together, and the outcome should benefit everybody.
Great, thanks. So as you can all see, we have Peter and Glenn's contact information up here. So we have a lot of questions to get through and only 4 minutes in which to do it. So we're going to get through as many as we can. We'll follow up individually with anyone who has a question still remaining after the presentation, but also feel free to contact Peter or Glenn directly if you have any questions. So just jumping in here, Mark wants to know, do development losses in a C Corp flow into the C Corp?
Sorry, could you repeat it, please?
So development losses create what's called a net operating loss, and yes, you are able to take net operating losses over time, and that becomes an asset of the company over time.
Okay. Brian wants to know, should founders insist on acceleration of stock on acquisition clause?
I would say most at least try to do that, and it's generally I would say if you try to do it, the likelihood is you'll make some progress with the investors on that. So I would say yes as a general answer.
Okay. Going back to what you said before, you mentioned the general percentage for Series A, but you didn't mention for seed. Can you give a typical percentage for seed?
Really give an overall percentage because it depends on the relative size more than anything else. We talked about the discount, so that really goes to the pricing. But in terms of what percentage the seed ends up with relative to the Series A, it really depends on how much money came in at each stage.
And to echo what Peter's saying, that's the whole reason why there's convertible debt, is that people have such a hard time determining what the pre-money valuation of the company should be. So if I'm going to put in $1 million in this seed, if I can't determine and agree on with you, the founder, what the pre-money valuation is, we can't really agree on how much of the equity you're going to give me.
Okay, yep. In terms of board, a couple questions here. Should the board be a mix of A-round investors and advisors closer to the founder and executive team so as to protect the founder?
Usually the Series A investors, particularly if they're venture capitalists, are going to have a very strong opinion or set of opinions about the composition of the board, and they're going to want to limit the size. Very often the post-Series A board is just going to be 1 or 2 founders and a couple of investor representatives, and they're not going to want others who are not investors. Later, it'll be important to have, they'll switch their position in terms of independent directors, where they're looking to buttress the capabilities of the board and the management team with people that are industry gurus and that sort of thing. But usually at the beginning, smaller is generally believed to be better.
Okay, great. Can you tell us what's a normal equity amount for a CEO?
Well, again, varies all over the map, and it, a function of how much money comes in and how, what kind of, if you're dealing with a serial entrepreneur who's, a former founder of a hugely successful company, that person is going to command a higher percentage than somebody that's maybe their first time. But I would say, in the end, after multiple rounds, a CEO is likely to end up with somewhere between 10 and 20%. Again, it's all about how many rounds, how much capital is raised. You can sort of back up from that in your capital plan and sort of figure out what, as a founder, what you need to have at each stage. It's sort of the same logic that the VCs use. You can use the same logic for yourself.
Great. We have so many more questions here, but unfortunately we find ourselves running out of time. So again, if I didn't get to your questions, I'll make sure that Peter and Glenn get these questions and they will follow up with you, or you can reach out to them. Also, you'll receive a follow-up email from us that will contain a link to this presentation as well as the recording, so you can check back in with that, and also you can tweet us questions or just email us. So thank you so much for your time. I want to let you know, too, our next webinar is scheduled for June 16th. It's 5 ways to reduce employment law risks for early growth companies. For this presentation, Glenn will be in conversation with Karen Reinhold, who's another counsel from Hopkins and Carley, and they'll be discussing the 5 greatest employment law risks that early stage companies face and how to mitigate these risks. So thank you for joining us. We hope that you'll join us again for another webinar, or we hope to connect with you again sometime soon. And thanks again to Peter and Glenn for a fantastic presentation, and to all of you for attending. Thanks, Peter. Thanks, Glenn.
Thank you.
Okay, have a great day, everyone. Bye.